Hi, and welcome to this month's Tactical Workshop. Today we're going to hear from Christian Frederigo from Get Capital. Christian's going to talk about SME and what you can do to get the most out of your clients. Over to you, Christian.
Thank you. Good morning, everybody, and thanks for joining. Today, I'm going to spend a little bit of time sharing with you my insights about small business and what Get Capital can actually do to help you help your customers. So, we shall begin. Now, just to touch on what I intend on covering over the next 20 to 30 minutes, I'm going to cover a little bit of a lay of the land. I'm going to talk to you about what a typical small business owner looks like and what their business is made up of in terms of different debt. I'm going to run through what I call fit for purpose, so different solutions for different needs and how you can use that to have a far better conversation with your customers. How to spot opportunities and what to look for. We're going to try and give you some tools, and we're going to give you an example which relates to a particular piece of documentation. Hopefully you'll find that valuable, and I'm then going to touch on how we're there to help you help your customer. So, we'll begin. I wanted to just spend a minute or two setting the scene. Now, this is information that some of you may already be aware of, but I think it's really important to understand exactly the size of the opportunity with your customers out there. So, approximately 2.3 million trading businesses here in Australia, of which 95% are SMEs. 57% of Australia's GDP actually comes from an SME, and that accounts on the last tally to 1.45 trillion. So $700 or $800 billion of Australia's SMEs coming from small business owners. So it's a really significant proportion, hence why it's been labelled affectionately as Australia's engine room. So I wanted to reference a report I saw the ABS do about a year and a half ago, and they surveyed a variety of small business owners, and what they were really looking for is what are the main reasons why you need access to debt or equity finance. And this actually helps us shape our offering to you and to your customers. It's important to understand that we're solving for something. The four things that jumped out at us: maintain short-term cash flow or liquidity, replace or purchase equipment, machinery, pursue expansionary opportunities, ensure the survival of the business. And we've endeavoured to shape our product offering to suit those needs that we know are dear and important to business owners. Something very interesting, this summarises the distribution of business loans under $2 million by loan size. And I think that the really big thing that stands out for me is that the vast majority of these business lending loans that are done here in Australia are facilities under $100,000. Now that tells me that it's not a commercial property loan, it's probably not a revolving facility. What it actually is, they're small business loans. They're term loans, that's the sweet spot, and it's probably a function of how easy it is to secure and exactly what they need to do with that money in the short term. So, at Get Capital, we feel it's really important to understand exactly who our customers are, and that includes you and the customers that you actually serve. So what we decided to do is we took a bit of a deep dive into our own customer base to get a good idea as to what a typical SME looks like. Now, I think it's actually a trick question. There is no such thing as a typical SME. Every business owner has a different flavour, different shapes and sizes. So I think it's just good to understand exactly what that typical Get Capital customer looks like. It'll help give you guys some context as to who the customers are that we actually serve and that you guys are looking after on a day-to-day basis. Minimum Equifax, maximum Equifax, with 60% or more of Get Capital's directors and customers having an Equifax score greater than 700. Time in business from 1 year through to 60 years. So from a first generation business right through to a second or even a third generation business, with the average being 6 years in time in trading. Annual revenue from 100K through to 30 million. SME is a really broad space. And as you can imagine, it covers anyone with a turnover from 0 all the way through to 50 million. The average turnover is about $750,000. And property ownership. 45% or more of Get Capital's customers own at least one property. So as you can see, here is the typical Get Capital customer. And I'm sure if you think about how that relates and compares to your own self-employed customers, you should find that there's quite a few of your customers that fit that box. So, small business turnover. We've isolated medium-sized enterprise because that typically carves out your large-scale businesses, and what we're left with is a small business cohort, 63,000 in monthly turnover. And what I thought was interesting, your average EBITDA margin being 15% means that most small business owners, on average, are earning a profit of around $115,000. Now, the point I'm making here is it's incredibly important to maximise your cash flow and optimise your business, given that there's not a lot of money here. And if you think about the cost of living, you need to ensure that that bottom line is maximised to suit the needs of your business and your personal position. Hence why managing debt and using it to your advantage is super important. 44% of customers we looked at have equipment finance debt, with the average number of facilities being 3. And 49% of these same customers had commercial debt. The top 3 forms of commercial debt these customers had: overdraft or a line of credit, a commercial loan, and a business loan. So if we have a look at a typical business owner, most of them are using multiple forms of debt to manage their day-to-day business. It's not just one form of debt. So it's really important when you're having that conversation with your customer that you endeavour to understand exactly how their business is put together and what they're doing to manage their cash flow on a day-to-day basis. Okay, fit for purpose. In the spirit of how Get Capital like to do things, we like to ask questions so we better understand how we can service you guys and your customers better. We did a broker survey recently, and one of the questions we asked all of our brokers, we wanted to know what the main challenge is when thinking about offering commercial and asset finance solutions to your customers. And what came up, which I thought was really interesting, is a large percentage of you said that there's no challenge and we're really good at offering and servicing our customers, which is excellent. There's also a large percentage there that said that the biggest challenge you guys are faced with was knowing which lender product will suit my customers' needs. So what I thought I'd do today is give you guys a bit of information about the different commercial lending products out there that a business owner might use to manage their day-to-day. Okay, so here we have a graph. On the vertical axis, we have what we call frequency of use. Up the very top, you have high frequency usage, and down the bottom we have low frequency usage. So typically something that sits in low frequency usage will be a one-off, might be an equipment purchase. One-off, never to be used again. Up the top might be more of a revolving facility or something that's required to be used time in and time out. Now down the bottom we have the tenor or the average loan term for the particular product. We're going to go through these different products. Now there's a hell of a lot of products out there. I'm just going to cover what we see as the most relevant and popular. The first being something called trade terms. And for the benefit of those who already know this, my apologies in advance. We're trying to cover a fairly broad range of solutions here. So trade terms, for those who don't know, when you're a business owner and you have to purchase stock, you usually purchase that stock on terms with your supplier. Now those terms might range from COD through to 7 days, spanning out to about 30 days at a maximum unless you've got a special arrangement with your supplier. Now, by the time you acquire that stock and you convert that to cash, that might take anywhere from 90 days right through to 180 days. Trade terms are a way business owners can cash flow the purchase of their inventory for a period of time it takes them to actually convert that into cash and pay that supplier. Okay? Typical trade terms, as I mentioned, range from COD 7 days out to 30 days. It's quite a short-term facility and it's often used on a regular basis to purchase more stock. Next, we move with something people would be most familiar with, a line of credit or an overdraft. Most business owners legitimately have an ongoing need for working capital or cash flow. And for that reason, the most appropriate product to help people manage their day-to-day is a line of credit or an overdraft. Now, the key difference between a line of credit and an overdraft is a bank account. An overdraft is generally linked to a bank account and allows a customer to draw beyond a zero balance, going into debit and obviously paying a premium for that debit balance. Line of credit is a loan facility, and obviously you'll be making frequent repayments based on the amount or the average running balance. Invoice finance or debtor finance. Similar to trade terms, this relates to an asset that's actually quite uncommon or unfamiliar to most people out there. You have customers who make purchases with you, or you're offering a service and those customers are taking advantage of that service, and there are terms in place. So your payment terms with your customers might be 60, might be 90 days. Debtor finance will actually offer you the money up front and take control over that debtor ledger. It's quite a valuable asset, and it allows a business owner to access working capital against the future value of that debtor ledger. Okay? It's a really good way to release or unlock cash for your business today for something that you're entitled to in the future. Then we move down to a business loan. Now, a business loan, for those who have had access or had some experience working with business lending providers or online lenders, a flexible business loan or a cash flow facility is usually given to people who require short-term cash relief. Okay, it's typically offered with terms from 1 to 2 years, and it's usually used for day-to-day working capital, pay wages, suppliers, whatever it may be. It can even be used to pay ATO debt as well. You then move out to a term loan. Now, term loan is a term, no pun intended, that's commonly used within banks. A term loan is something that's usually offered for longer term requirements for a business owner, and that might be more linked to expansionary or growth aspirations for a business. So an example of that, there might be a management buyout and they're looking to fund that particular purpose with a term loan. Now, a term loan is usually a facility that ranges from 1 year all the way through to 5 years, and at present, it's a solution that's typically offered through your mainstream lender. Equipment finance. I think most people should be familiar with equipment finance by now. For the benefit of those who may not be, equipment finance is financing the purchase of your car, truck, or asset or piece of equipment that relates to your business. It's usually an asset that's income generating, and as you can see in terms of frequency of use, you might have an ongoing need to finance your equipment, but it still relates to a one-off purchase for that particular asset. And down the very bottom, we've got commercial property loan. Now, this relates to a commercial loan for the purchase of either a factory, business premises, or something along those lines. Now, the typical terms for a commercial property loan will range out to 15 years or quite possibly even out to 20 years, and they'll come with a set of rules and repayments. So you might have options for interest only, for principal and interest. There might be an introductory period for 5 years where you can take advantage of an interest-only headline rate. But the amortisation is typically done out to 15 or 20 years, keeping the repayments at a minimum. Now, these loans are always secured against property. Okay, so there you have it. They're the most common forms of business finance that we come across on a day-to-day basis. So as you can see, for a business owner, and you guys yourselves are all business owners, the landscape is incredibly complex, but understanding how these different facilities can be used inside your business will help you guys add value to your customers and help them optimise their business. Okay, we'll move on to what we call use case. What I'm trying to do here is basically give you guys a couple of examples of what a customer is trying to do and what the products are that actually serve that need. We'll start with the most common one, purchased asset or equipment. What products out there can I actually talk to my customer about? There's a whole variety of different equipment finance products out there, all of which have a very unique purpose, and the differences between these products are vast. We'll endeavour to sort of compress this information in a future slide and talk to you about the most common two forms of equipment finance as well. Hire purchase, lease, rental, chattel mortgage. Now, these may not be all your options too, but we're just covering what we're going to see as the most common forms for today. Managed cash flow, something that every business owner faces on a day-to-day basis. Your options are a term loan, a line of credit, an overdraft, even invoice or debtor finance. So understanding which product might suit the customer's needs better or most appropriately requires a more in-depth conversation. Grow and expand. Term loan. As I mentioned in the previous slide, term loans are typically for growth or expansionary needs, things like fit-outs, pushing more towards what you would call CapEx rather than working cap. Working capital is the term I use for your day-to-day requirements. CapEx or capital expenditure are things like asset purchases, fit-outs, growth needs for a business. Business purchase, term loan. Managing supplier payments, trade terms, or even invoice finance, depending on whether you've got to pay your suppliers or whether you're waiting to receive money from your customers. And finally, fit-out. Well, fit-out can be a variety of different options. It could be equipment finance solutions, hire purchase, lease, rental, chattel mortgage, or you may even want to consider a term loan, depending on your relationship with your lending partners. So, jumping into equipment finance, as I mentioned earlier, there's two that stand out over and above all the other lending options when it comes to equipment finance. You've got a chattel mortgage and you've got a finance lease. Okay, and there's a lot of different benefits when people look at when debating which one suits their needs better. I'm going to cover some of the key benefits, we'll call it pros and cons for finance purchase, which is a chattel mortgage, versus finance lease, which is more of a rental or an arrangement where you don't actually own the asset. So, GST, big benefit with a chattel mortgage, you get to claim the GST. When you're leasing an asset, you actually don't own the asset, therefore there's no entitlement for you as a customer to claim the GST. Ownership's a really important thing here. On a chattel mortgage, the borrower has ownership over the asset, and that's why they actually get the entitlement to claim the GST. As a finance lease, it's actually the financier that owns the asset, therefore there's no entitlement as a customer to claim the GST when they're leasing an asset. It's actually the lender that gets to claim that. Interest and depreciation. Now, at this point in time, I will just make a note, I'm not a qualified tax advisor. It's really important when you're talking to your customers or when you're evaluating which option serves the purpose best to encourage your customers to talk to their accountants, because only the accountant will know exactly what's going to serve the business owner best. Okay, the purpose of this exercise is to give you some basic insight into the key benefits and differences between chattel mortgage and finance lease. Okay, interest and depreciation. These are really significant tax deductions. Under a lease, you actually don't own the asset, therefore you can't claim these things. 100% of the payment. So if you reverse these two things, if you're leasing an asset, you actually get to claim 100% of the payment as your deduction rather than claiming the interest and the depreciation. Flexibility is a big thing when it comes to looking at the finance arrangement that serves the needs of the business best. With a chattel mortgage, it's a product that provides complete flexibility around structure, term, final balloon payment at the end, deposit or no deposit. You get all of those privileges when it comes to a chattel mortgage. Under a finance lease, it's quite rigid. Your lease needs to be structured on a particular term and the final payment needs to represent the estimated value as per the ATO. So you don't get that degree of flexibility when you're looking at a finance lease. Now, if we were to look at which product out there is the most common, as a lender, what we see is about 90 to 95% of all finance arrangements are done as a chattel mortgage. Now, that being said, it's really important to ensure that your customers speak to their accountants before making that decision. Okay, I wanted to give you guys 3 key examples on what to look for, what to ask your customers, and how to spot the opportunities. And I like to call it the what, why, and the so what. Okay, we're going to start with a particular question that I think is really simple and it actually reveals a great deal about a business owner. Okay, the question is this: what facility do you use to manage your cash flow or your working capital needs on a day-to-day basis? So do you actually have a form of debt that you're using to manage that? Why are we asking that? Well, the answers are simple. They may not have one. They may not have enough. They might have a facility with their bank and that might not be enough to help them manage their day-to-day. They might actually be using their cash reserves. Or they may even be using their personal credit card to cash flow their business, and we do actually see a lot of that as a lender. So what? What are you going to do with that information when you get it? Well, this is the explanation. Bank facilities are often hard to secure and may require property as well, and that may not have necessarily suited your business owner or your customer. So there's an opportunity there. They may need to secure additional funds based on a current shortage they have with their bank or their provider. If they're using cash reserves, it may not be the most efficient usage of their cash reserves or their working capital. That might be best suited focusing on buying more stock or expanding their business too. And securing business cards, if anybody's ever tried to do it, it's extremely challenging, and often if you can get away with it, you won't end up with a limit sufficient enough to serve your needs as a business owner. So a lot of people, business owners, generally fall back on their personal debt to do that. It can be extremely hard to manage from an accounting perspective, and it muddies the waters when you've got your personal position and your business position all blended together. So one simple question can reveal a hell of a lot of opportunity for you guys and how you can actually serve the needs of your customers better as well. The next one I'd like to touch on is bank statements. Now, for those who don't know, Get Capital, one thing that's really unique about Get Capital, we use bank statements to assess the creditworthiness of our customers. We get to see a hell of a lot of data from the bank statements. It's actually really empowering, and the information you can use to have a good conversation with your customer there is just endless. I'm going to touch on a couple of things you'll get. So if you're not already seeing bank statements or acquiring them from your customers, I'd strongly encourage you to do so. The why. Two things. You'll get a sense of supplier payments. Okay? And like I said before, you've got that concept of trade terms, receivables, money in, money out. It'll give you a sense as to whether they're struggling or how they're actually managing their day-to-day. You'll get a sense as to what their cash conversion cycle might look like, and you might even get a sense as to whether there's some concentration issues there as well. What you see in the bank statements, when you've ever seen a set of accounts that come through via bankstatements.com, it categorises it for you. You get to see who the key suppliers are. And you might also then understand whether your customer has one contract that funds 80% of their business or whether they have multiple contracts. And it's important to understand the delineation between a business that's successful because of one major government contract or a business that's successful because they have a broad and diverse income stream there too. The other thing you'll get to see is ongoing loan repayments. You'll get to see their credit history, whether there are any dishonours. You'll also get to see exactly which lenders they're making repayments to. So in my opinion, that is a great opportunity to bring that up with your customers and mention that they've obviously got a loan with Get Capital or they've got a loan with Macquarie, and understand what that loan's for, and if it's for an asset, that might be coming up to the end of term and they might have a need to upgrade or replace that particular asset. So there's an opportunity to use that information and bring it to the surface and talk to your customers so you better understand how they're managing their business with different forms of debt. The next one, financial statements. Today I just want to talk to you about what you can see in the asset and liability or the balance sheet. Why and so what? Two things. It's right there in front of you if you ever looked at an A&L. Accounts payable and accounts receivable. This is the amount of money they're paying to their suppliers and how much money is owed by their customers. Now, it's a really easy way to identify that there's a receivables gap. When you have more receivables than you do payables, it typically indicates that there's a mismatch between your supplier terms and your customer terms. And that's usually a big indicator that they need some form of working capital finance to help bridge that gap. They might have it, and that information will actually also be shown there on your A&L. Current financial commitments will show you exactly the different forms of debt your customer has. It'll show you which lenders they're using, and it'll give you a rough indication as to how much they actually have outstanding. These two things together are really powerful. They give you a genuine sense as to how well the business is put together and how well they're actually managing their day-to-day operation too. Just those two things alone will give you quite possibly 1, 2, or even 3 opportunities to help your customer with finance. So, as a lender, what can we do to help? Look, we're committed to servicing you guys. Our job is to empower you to have better conversations with your customers. Okay, and we understand every business is different, so we've offered you guys a tiered broker support model. We can offer you the spot and refer for those who lack the comfort, the competency or the ability, or who are quite possibly time poor, all the way through to the full broker service model, empowering you guys to have that deep conversation with your customer. Okay, we also have BDM support out there on the road in every state, which offers you the onboarding, the training and the education piece. We also have BAM. What we call broker account managers. They sit next to credit and they're there at your beck and call to talk about workshopping, scenarios, transaction needs, status updates. You can lodge your deals digitally. You can also track your status through our broker portal. We've also got our partnership through Connective, which gives you access via Bolt. And I guess our range of solutions, just to reinforce the message, are there to assist your customers with what we call run problems and grow problems. And this is what I mean when I say run problems and grow problems. Day-to-day working capital is what I call your run problems, your day-to-day. Grow problems are expansionary problems. These are the two key areas that Get Capital has focused their service on. On the day-to-day, we've got a business loan and we've got an import line of credit facility. On the expansionary side, we've got a term loan. We can offer you equipment finance for your vehicle, for your general equipment, and also for your fit out. And very exciting, and you will hear more about this over the course of the next few weeks, we are launching a business overdraft solution, which is going to be core to most of your customers day to day. So I wanted to leave you with a few exciting points on this business overdraft. This is a standalone facility that doesn't require your bank, no bricks and mortar security options up to $150,000, quick decisioning, no financial statements for your assessment, and minimal fees and flexible repayment options. This facility ranges from $20,000 to $500,000, has a 5-year time frame with no annual reviews, flexible repayment options. Price-wise, it comes with an annual fee of $395, no establishment fees, no drawdown fees or ongoing fees. And the qualification criteria fits right in the centre of most of your customers too. So if I can leave you with one message, have a think about aligning your lender partnerships that enhance your own core values and competencies as a broker and what you're looking to do to service your customers. We want to partner with everyone. Thank you very much for listening. Encourage you to reach out to our BDM team if you haven't already. All the information's available on Mercury. Thank you very much for listening.
Thanks so much, Christian. That was really interesting. I think I've learned a lot more about SME clients and maybe what sort of loans we can do for them. If anyone has any questions, please send them through now and Christian will respond. We've got one here, Christian, from Jared, who asked, do you have anyone who would consider income from the business being purchased for servicing? So when you're purchasing the business, the proposed future income servicing against a loan.
Look, with us as a lender, we need an existing trading history in order to consider a business purchase. As long as there's an existing business and they're looking at purchasing a new business, it's okay if we need to look at it in a separate entity, but we do need an established history or track record of trading. So we can use the current business to evidence that they can support the money they want to borrow to purchase the new business. So if it's a brand new purchase and they're not doing anything at the moment in terms of trading, it's probably not a deal for Get Capital. But if the former holds true, then by all means, we'd love to look at it.
And Christian, some of our brokers might not have dealt with the SME clients before, and it can seem a little bit scary to get started making loans in this space. What's your one tip you'd give our brokers to get started?
Look, I think it's okay to be nervous. If you've never really dived into the space, it's actually not that mysterious or challenging either. Reach out, have a conversation with one of our sales guys. We're there to be the experts, we're there to be professional, and part of our job is actually to work alongside your business and give you the tools you need to service your customers better. So that one tip again, give us a call.
And also, we have a great team here at Connective as well.
Absolutely.
Who you can always reach out to. We've got a scenario support specialist who can help out with asset finance space. So if you're not sure how to do a loan, you can speak to Steve Light in our asset finance team as well. Sam has a bit of a specific question. So Christian, from a Get Capital perspective, if a term loan is at $400,000 for a business acquisition, does this need to secure against a property?
Look, I think it comes down to the individual circumstance of the business and the profile itself. The short answer is at that level, it's quite possibly a deal that would need property security. Having said that, we assess every deal on its merits and we have done lots of deals for term loans upwards of $200,000 and $300,000, which have been done without property security. So I think it's case by case. It's not going to be down to the actual policy, and that's one thing that's unique with Get Capital. We're not really bound by policy. The policy is there as a guidebook to give you guys some clarity and certainty around where our appetite sits. Outside of that, there's a lot of things we can do if it makes sense commercially.
I think that's a great point, Christian. It's with asset finance, it can often be you have to work the scenario and see what it works. So yeah, definitely give you a call. That's all for the questions front. If anyone has any questions after this, feel free to send us through an email. Otherwise, you will receive a copy of Christian's slides after the presentation. Thanks so much, Christian. That was very informative.
Thank you.